just sitting there when the market going down, hoping. Why hope when you can sell short and make money? Either way, you make money when the market goes up, you make money when the market goes down. That's the benefit of Phil's Gang. You make money.
Become a Phil's Gang member and receive the training, advice, and software that will take your investing to the next level.
philsgang.com. Sign up free for 10 days.
Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Well, the market, you can see, is now negative. It was interesting today. I was watching on the Jibber Jabbers on Fox Business, talking about how exciting everything is, that we hit a new high yesterday, S&P, and the inflation's coming down, and wages are going up, and so forth. I just wish somebody would get the facts straight. Now, to me and my members, it doesn't matter because we follow the money. And we can do that because we know how to sell short as well as go long. The folks who don't know how to short have to trade to perfection, which means all they do is can buy. That means they got to really work at it. They got to trade to perfection. It's almost impossible. But getting back to the story here, that when they're saying how everything is just wonderful, and they pointed to how exciting we hit a new high and how exciting it was on Wednesday. We had a over 500-point rally when they cut rates. Well, remember, that 500-point rally, okay, it didn't last very long. And why? Because remember what I said about what was going on here. If you recall, Powell said in his speech that he was going to turn around and start printing $40 billion a month. So I'll keep it for 2 to 3 months. And he's going to use that money to buy treasuries. Really? That sounds awful familiar. That sounds like QE. That sounds like the 35% inflation that we got caught in from 2008 to 2022. Anything that you purchased in 2008, you paid 35% more in 2022. In fact, you paid 50% more in 2025. Inflation went up 15% between 2022 and 2025. Now, the market's been rallying, but we've gone into a rotation out of the tech stocks into the bank stocks, into the gold stocks, into our defensive stocks, I call them, or discretionary stocks, okay? Now, why is that? Well, I'm going to explain. First, let's go back to reality. If you notice, the 10-year Treasury is rising. Exactly what I said would happen, happened. If you recall, I said when they cut rates, we always see it happens. It goes the wrong way first. The market, the yields go the wrong way. And then they'll turn around and come back the other way. Sometimes they can do it twice. But you've got to let things settle down overnight, at least for one day, because the institutions, the big buyers, the people who make everything happen, they just don't, sit there and say, oh, gee, look, we got a rate cut, let's go. No. They mull it over, and sometimes it takes them a day. And then what happened after that mulling over? Yields are going up. Exactly what I said would happen, because remember, if we go back to 2024, inflation remained above the target. We had a cut of 50 points, and that wasn't enough to stimulate the economy. And the worst thing, the deficits were increasing, and to not increase the yields so that we could attract investors like UK and Japan and China is insane. And that's what happened. Nobody wanted to buy our debt. That's why in 2024, the yield went up instead of down. The same thing's happening today. So after one day, they mulled it over, and they're saying, no, the three reasons that the yield went up in 2024, September 17th, we have the same reasons, but worse. But let's see what happens on Monday. Maybe it'll come back the other way. As I said, it'll bounce back and forth for a couple of days, and then it'll finally settle down. But let's get to the meat of what's going on here, okay? Yes, we got rotation. We got rotation going on, and that's fine. There's nothing wrong with a rotation, okay? But what is important to remember, Trump is really upset that the 10-year Treasury yield is going up. Remember, he was fighting to cut rates, because he is tired of paying our debt, our national debt, our deficits with short-term T-bills of 1 month, 2 months, 3 months, the most a year, because he knows when you're paying your debt short term, you don't want that. You want China, you want Japan, you want somebody to come in and will loan you money for 10 years or 20 or 30 years, buy those bonds from you. He can't get anybody to do that right now. So now he's doing T-bills. The problem with too many T-bills is first, it makes us, our whole government unstable, our financial system unstable. It's like putting your entire mortgage on a 1 month adjustable rate. In other words, there's big problem. Paying deficits and debt with short-term T-bills, you need to keep rolling over the T-bills. They'll say, let's roll them over. You got to roll them over. You got to roll them over every month. Now, what happens when you do that? It's very dangerous, because when you start rolling over trillions and trillions of dollars in short-term debt, rates can jump. I've seen rates jump overnight. Crazy, explode overnight. That's very, very dangerous. So this is what he's got himself into right now. He's watching that yield going up. He's very, very upset. You can't blame him. So we know why the yields are going the wrong way. Now, let's talk about the 500-point rally. Why was everybody so excited? Why did we hit 500 points on Wednesday? Well, the big thing that drove it was this statement right here, which is a bunch of BS.
As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months.
Okay. It's the same thing he said back in 2008. Not him, but the Fed. It was Bernanke and Obama. They said, we're only going to do QE for a couple months. That's it. 90 days the most. We're going to print money, and then we're going to borrow. We're going to print money, and then we're going to take that money, and we're going to go and we're going to buy treasuries. We're going to buy 10-year treasuries at the auction, so we can get that 10-year treasury yield down. Hopefully your car payment comes down, your mortgage rates come down, your student loan, your credit card, your business loans all come down, and that will stimulate the economy. That's what we're going to do. It didn't work. It didn't work. Now let me tell you why. And this is what we're starting again. Now he didn't call it QE. They're not going to call it QE. They're going to call it some different name. So more rate cuts are coming is what got everybody excited at first. But when he came back and said he's going to start printing money, take that money, their treasury's going to print the money, give it to him, and he's going to go and buy treasuries, 10-year. This brings back 2008. Yeah, we had a great rally in 2008, but let's take a look at it. Oh, the other thing they were excited about was that they think Hassett's going to be the new chair. Well, that's in question now, because a couple times Hassett, in speaking, he pretty much agreed with Powell that rates should really be going up, not down, because we have not hit our inflation goal, and that's one of the reasons why the yield's going up. But let's go to, so again, when Powell announced that, the clock started to come back to 12. Obama, Bernanke said in 2008, same thing, we're going to borrow $80 billion a month for just a few months. It started. Now think about this. After the 42% 2008 crash, okay, decision was made by the wealthy, the bankers on Wall Street, the top 1%, top 10% who control everything, by the way, the top 10% receives 90% of all the stock gains, all the stock profits. They said after 2008 to Obama, who they put in the White House, it's going to take us so long to call back 40% in losses. We're going to do QE. We're going to do what Japan did. But they said, well, what Japan did failed. Yeah, but the rich got richer. We don't care about the middle class. We don't care about the poor. So what they said is, look, they're going to turn around and they're going to print money. And all they want to do, again, is to get back the market back as fast as they can. Usually what happens after every crash, I don't care if it was 1931 with 47%, 37 with 38%, 74, 30%, all those times, what do? They take the money, they get that money to use it for increased business investment. They take and use the money to get new machinery, new equipment, IT spending, build new plants, to increase productivity, to increase wages, to increase GDP. But these characters, Obama and Bernanke, remember, Obama was owned by the bankers, just as the Clintons were owned by the bankers. They said, we're not going to wait all these years to get our money back. So here's what we want to do. We want to go ahead and buy those treasuries as quick as we can, the 10-year treasury, so we can get those yields down as fast as we can. And that's what they did. So they started that in 2008. The decision was, let's not worry about productivity. Let's not worry about economic growth, which means you're not worrying about the middle class. You're not worrying about the workers. They screwed them. The only people that make money in this kind of policy is the very wealthy, not Main Street. And they said, oh, don't worry. It's all going to dribble down. It's going to dribble down to Main Street. I remember. And they were lying. It didn't dribble down to Main Street. So first, think about this. From the first thing they did, the Fed dropped its rate from 5% in 2007 to near zero, 0.38. That's the rate at which they're going to loan money to banks overnight, so they can start doing stock buybacks. Then came the increased money supply. If you're going to, again, buy 10-year treasuries, and like he's going to do now, $40 billion a month, back then $80 billion a month, if you're going to start buying those treasuries, you need to print money. That's inflationary. You got to increase your money supply. They increased the money supply from 2008 to 2022, 166%. The money supply. You got to have a supply of money to go buy treasuries, 166%. Or 300 billion was printed to rig the market to buy these treasuries to get those yields down so the stock market would go up. 300 billion. Now, 2008 to 2022, we had 4 different QEs. And this is when the problem started. This is when inflation started. November 2008 to March 2022, another one we had. November 2010 to 2011, September 2012 to 2014. Biden now comes in, 2020, 2022. So what the hell's going on? What we're doing is propping up the stock market. And who's getting terribly wealthy? The very top 1%, or let's say the 10% where they get 93%. This was all built back in 2008, designed in 2008 for, again, that they could call back their losses quickly and screw Main Street. The consequences, inflation, in November 2008, when they started, was only at 2.8%. So in other words, if you went out and bought a shirt, you're paying 2.8% more than previously. In January 2022, you were paying 36% more for that shirt than in 2008. 34%, 36%. That's inflation. In other words, the cost has gone nuts to borrow all this money to move the stock market up, and they decided to move it up this way, and the hell with the people. The inflation we don't care about, because we get the 1%ers and 10% get 93% of all those stock gains that went up almost every day. That was think about that. That's 50% more. In other words, from 2008 to 2022, you paid 36% more for that shirt. Now let's go from 2022 to 2025. That was a 15% increase. You're paying more for the shirt. Yeah, inflation's gone up 15% from 2022 to today. So overall, from 2008 to 2025, inflation has gone up 50%. And the dollar's gone down about, 48%? I'll check that number. So why is QE good for the economy? It's not. It's not. So here we go again. We're going back to QE. But it doesn't matter to me, doesn't matter to my gang members, or anyone knows how to sell short and know how to go long. Because then you only follow the money. It doesn't matter. We make money no matter what the decisions they make. It's the decisions that kill you. I'll be right back after this break.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
Hi, I'm Phil Grande of philsgang.com. Over the years, I've successfully taught tens of thousands of investors how to navigate the market with confidence. Become a Phil's Gang member and receive the training, the advice, and the software that will take your investing to the next level. I have a team comprised of successful investors, all with proven track records. And the Phil's Gang software is easy to use, painless to navigate, and tells you exactly when to buy, when to sell, when to hold, when to run like hell, even short. Learn about common market mistakes and how to minimize them. You don't have to be a seasoned investor to benefit from Phil's Gang and platform. No matter what level investor you are, my strategies for investing are designed to put you on the path to success. Sign up for the 10-day free trial to see our platform in action. Avoid market pitfalls and start winning with Phil's Gang. Learn more at philsgang.com. That's philsgang.com.
Welcome back. Are you ready to make profits in the stock market? Why not check out philsgang.com or give us a call, 877-600-4264. Now, here's Phil.
And welcome back. We're doing so well with our gold stocks, our mining stocks. We bought our mining stocks, GDX, back in, I think it was January this year. I told my members in January, I said, we're going to make all our money this year is in gold because there's so much uncertainty out there. Our debt is crazy. Our national debt, our deficits. They're never going to take and cut the deficits. They will never do that. Never. And it's not going to happen. The delinquencies that we're having on mortgages, car payments, credit cards. Yes, wages went up. Sure, they went up. But what went up even more is the cost of your cars, cost of your home, cost of your food. We have record job losses. But our stocks, again, when you look at our stocks, our gold stocks are going up. Our silver stocks are going up. Our bank stocks are going up. There's a big rotation of bank stocks. And I want to address that for a moment. All I keep hearing from people when they say, oh, the bank, 600 billion lost, those aren't real losses, don't worry about it. What? They don't have any understanding. To say that the 600 billion has that they're all fake, phony, no, they're not. They're just undisclosed. They're just undisclosed. Which they call unrealized instead of realized. Unrealized. Well, remember, we had a bunch of banks. The same thing happened. We had 3 banks. That was in March of 2023. The same thing. They made a big mistake. They went out and bought treasuries that were fixed around 2%. Fixed. And then when everything went bad and inflation goes up, when you're sitting there and you're buying $40 billion a month, $80 billion a month, printing money to purchase treasuries, to try to get the 10-year yield down, to fake everybody out and to, oh, look at that, your mortgage rates are down, your car loans are down, your credit cards are down. It's the inflation that gets you. So, again, we are on a good run right now with the bank stocks, with the gold stocks. And again, with our other, our defensive stocks, as I like to call them, discretionary stocks. But going back to the banks, those are real losses. Here's how it works. Hear me out good, because if you are one of the people that say, oh, don't listen to Phil, those aren't real losses, really? Okay. As long as the money stream of these banks keep coming in to keep the cash reserves at a level that they're mandated to, let's say you have a bank and you're mandated to keep your cash reserves at 10 million. As long as you got enough money coming in, your cash reserves won't go down. So when you were dumb enough to buy treasuries at a fixed rate of 2%, and you thought inflation would never go up, and inflation did go up big time, and to fight inflation, the Fed, to fight the 9% inflation, the Fed had to raise its rate from 5%, from 2% to 5%. That means if you bought these treasuries fixed rate of 2% and the Fed rate's at 5%, that's how much money you're losing. But it does affect your balance sheet. Now, you don't have to claim these losses or recognize these losses until you're really losing money. What's that mean? It means that when you turn around and we start seeing all this money that's coming in slow up, why? Well, we start seeing that people can't pay their car payment. They can't pay their credit cards. Their payments are all late. Repossessions are up. Now, all of a sudden, let's say you have a $10 million mandate. You got to keep that reserve. Now it drops down to $8 million. Now you're screwed. That's when the losses become real. That's when you have to disclose them. That's when you head to insolvency, to bankruptcy. That's exactly what happened to the 3 banks in 2023. You remember those 3 banks? I wish I could remember the names offhand.
Silicon Valley.
Silicon Valley was the big one.
First Republic.
First Republic.
Signature.
And Signature, thank you. Same thing. They did the same thing. All right, so now we have, I hope, an understanding that these do affect your balance sheet if, in fact, all the foreclosures, all the late payments, all the you're not paying your credit card, that will hurt the bank's cash stream, cash flow. That hurts the reserves for bad loans. Those reserves drop below that mandate, bam, you now got to report those losses. So that's how that works. So don't listen to these people that say, oh, they're fake. No, they're not fake. As long as you got cash, they're not fake. So the money supply, okay, is really what kills you, the money supply. That really hurts. When you keep an increasing money supply to keep buying these treasuries. Now let's talk about the QE. Why do they do QE? Well, first thing, the Fed lowers the rate so that the Fed can go in, okay, and go to the banks and buy their assets, mortgage-backed securities and so forth, put them on their balance sheet. Now they have the cash. The assets are on the balance sheet now that were on the banks is on the Fed's balance sheet. The problem is, again, they still have to buy those back. Now they never do. They never do. But if we go back to this QE again, we start this QE all over again. The big problem is it's not going to work because who benefits from QE? All the CEOs, all the tech companies. Stock buybacks. I thought I had my list here. Let's see, give me 1 second. Here, just give you an idea. Take in the past 10 years, Apple, they bought in 10 years, $735 billion in stock buybacks. Why? Interest rates are near zero. Meta bought $207 billion. NVIDIA, stock buybacks, bought $89 billion. Google, $317 billion, and it goes on and on. Now, the problem with stock buybacks, it puts you into a boom to bust cycle. Boom to bust cycle. Because the business investment, remember, provides a stable economy. But they don't use money for business investment. So we don't have a stable economy and we don't have a stable stock market. You got stocks that are going up like crazy, but there's nothing underneath them. Every time you take, and let's say you got 2,000 shares outstanding, people trade all day long, you want to reduce that to 1,000 shares. So let's say your stock was $300. Now you say, look, I'm going to take my 2,000 shares, drop it to 1,000. That earnings go up, and you did nothing. It's called unearned increment. Earnings shot up, that pushes up your stock price. So your stock price went from 100 to 150. They buy more. Stock price goes to 150 now, to 200, to 250, to 300. Why do you think these stocks? You used to be able to buy plenty of stocks at $25, $50. Plenty. You try to find a stock at $25. Try to find a decent stock at 100. They destroyed the market for the little guy. They destroyed the market for the little guy. Don't give me this, oh, the 401ks are doing well. 401ks never do well because they never get out in time. Anytime there's a crash, they never anticipate it. They never get you out, and they want to keep you in. Remember, every crash, they never change the buy recommendations to sell recommendations. As the market's coming down, the stock's coming down, it still maintains a buy recommendation. Why? Because they need you to suck you in, the retail investor, to stay in the market, to hold the market up. If they didn't have you holding the market up with your stock buybacks, cost average, in a downtrend, what are you, nuts? But that's what they tell you to do. Buy on the dips. Buy on the dips when the stock's going down. Cost average down when the stock's going down. No, you do that on an uptrend. So what happens is they get out all of their clients, JP Morgan, Goldman Sachs, Morgan Stanley, Bank of America, Wells Fargo, they get all the pension funds out. Steel workers, police unions, concrete workers, they get all them out. They couldn't get them out if it wasn't for you buying on your dip. It wasn't for you cost averaging down. Because if you didn't buy on your dip, it didn't cost to average down. And if they did what was truthful, to change the recommendation from buy on the way up, and when it's on its way down, change it to a sell, the stock market go down in a minute and a half. They can't get their people out. So they screw you every time. Look at Enron is the perfect example. Kramer every day. You got to buy the stock. Buy in a dip. Buy in a dip. He was working for Wall Street. They're getting all their clients out. I'm talking about the big clients. Police, steel workers, the biggest labor union in California. So it's a boom to bust. Business investment, no more. They don't take that money, that QE, and buy new equipment, new machinery to increase productivity. Because when you increase productivity, you increase jobs, you increase wages, you increase the economy, GDP grows. Business investment has been replaced with this stupid stock buybacks. It's been replaced with this historic corporate and government debt to fuel all this corporate obsession with stock buybacks. That's what's happened. I'll repeat.
3 minutes.
This business investment that provides us a stable economy. Our whole country was that we were the best in production to produce. That drove the middle class. It drove consumption. And what are you trying to drive in consumption? Big ticket items. But now when they got rid of business investment and replaced it with QE, the corporation CEOs, the Congress, Pelosi, all it was this debt to fuel this. We just kept getting in bigger and bigger debt to fuel this stock buybacks, which again reinforces an unstable economy. But it looks like it's going. Long stocks going up. Oh, these got to be good. I'm listening to him on CNBC today. Oh, look at Fox. They're bragging how the economy, the stock market went up and hit 500, new all-time high. Well, how come they didn't talk about today? Why aren't they talking about the NASDAQ down 500 points? So remember, stock buybacks reinforces our unstable economy. And it's always dependent on increased debt. That's the problem. When you see stocks going up because of QE, it's all based on you got to depend on, can I get more debt? Can I keep increasing the debt?
1 minute.
You got to be in, only Wall Street benefits. In the end, when we have all this increased debt, all this inflation, I mean, think about the inflation. 35%, 38%? Are you nuts? Money supply. They keep increasing the money supply. What do they use the money supply for? Not only to buy treasuries, to bring the 10-year treasury yields down, but a lot of that money goes to margin debt. Margin debt. A lot of money goes to margin debt. That's how they keep you in. They keep going after the tourist investor who can't afford to buy stocks or hold on to them. But as long as they have big margin debt accounts, those people will stay in. They'll keep buying at the top. They're called FOMOs. They'll stay in as long as they can get the money. They don't care what interest they pay.
8, 7.
And that's why you always have a cycle of crashes. But on the way up, keep buying. On the way down, know how to sell short. We'll show you how to do that.
You have been listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.
It's up to me.